Hey guys, it's David again. This is Daily Thoughts number 12. I'm going to try to make this one quick, and every time I say that, it seems to be a 25-minute video, but this time I'm actually going to try to make it quick. It's been a long day and kind of a disappointing and very frustrating day. Another one this week. February off to not a very good start again, but that's okay. I got hair on my microphone, trying to get that off, sorry. Today we're just going to talk about the FOMC meeting today, which is the Fed's monthly meeting that concerns basically the prime rates for debt in the country, along with the general health of the economy. And Jerome Powell, who is the Fed chair right now, he came out today and they raised interest rates by 0.25% or 0.25 basis points, which is pretty much what everybody thought they were going to do. And the market absolutely just slapped off after that. I mean, the Dow was up quite a bit, almost 1%, I believe. S&P and NASDAQ, I believe, were up almost 2% by the end of the day. Crypto took off like a bat out of hell. I mean, just a really, really good day for the market after that announcement. I think everybody had already priced in that 0.25 basis points, and they were just kind of confirming what they already knew. So that's extremely good for the economy, extremely good for the market and people who are investing in all different kinds of assets right now to get that stuff out of the way. It's a very, very nerve-wracking time every month around this time period when they start talking about raising interest rates. So 0.25 basis points is a kind of a deviation from where we thought it was going to be a couple months ago. They have been raising interest rates quite a bit faster than that and quite a bit more than that. It was 0.75 and also 0.5 basis points before this in order to curb inflation. But now they've gone down to 0.25 because the inflation has obviously come down. That's not true. The inflation is still here. The increase of inflation month to month has gone down, is what they're really looking for. The Jerome Powell did come out and kind of suggest that the labor market is kind of weird right now, which I can absolutely attest to. The labor market right now is absolutely terrible. He did kind of mention that it's going to continue to be that way for a while. I don't think they're necessarily trying to sink the labor market and trying to create unemployment, but that's one factor that they're definitely looking for as the economy starts to slow, will be unemployment. And if they're measuring everything by the unemployment of the United States of America, I hope we get through this quickly so that the unemployed people can get back to work. So that was the big thing that happened today. And unfortunately, I still think we're going to have a recession this year in 2023. A lot of the economic factors, especially the manufacturing sector and the labor market, like we just talked about, are in very, very shaky territory. And I don't think that's going to change. I have seen a lot of comments on Twitter and other places around that I've kind of summed up how I feel about this. The economy was built on a lot of free debt for not free, but very, very cheap debt for a long, long time. I am fairly young, as you guys know, but before my time, when I was buying assets, debt was much more expensive. Buying a house at 9 to 15% in the 90s was not out of line. And now that we live in, the 21st century and we're now in 2023, we were used to this interest rate area of between 3 and 5% at the top end, 5%, which kind of got us into this. And it happened in 2008 also. Obviously, people were over lending to people, and also the people that were buying houses were over purchasing where their budget should have been, and so we had a lot of debt that was around that was maybe not secured very well, over leveraged banks, over leveraged institutions, and so we got ourselves into a lot of trouble in 2008, and I don't think we ever learned our lesson on that. We bailed out the banks, so they really didn't have any consequences, and that was American taxpayer dollars that, of course, went to the banks, multi-million-dollar corporations that just got lit on fire basically because they wanted to be extra risky with their portfolios, which is seems to be the theme of the government here recently, is bailing out big corporations when they make giant mistakes or when they just don't want to hedge their bets. or protect their consumers, customers, whatever. So anyway, now that we've gotten past that time period of really expensive debt in the 90s and in the 80s and such, early 2000s even, we went through a time period there between 2005, 2006, and we had our little dip there with the 2008 crisis, and we recovered in 2011 or so, and then we had another 10 years of just continued borrowing at interest rates that were so low that it was almost negligible for most people, right? As long as they could make the payment on their $100,000 Escalade or their $400,000, that doesn't sound like a lot, but in Indiana, $400,000 house is actually quite a bit. But they're over in California, they got $1 million homes and stuff like that are at interest rates of 3%, and so people thought that they could afford that. But now we're getting into a time period, especially with the interest rate hikes now, where debt is becoming much more expensive. The Fed prime rate is, I believe, between 4.25% and 4.75%, and so bank loans will be higher than that, obviously. And so I think that should slow down lending and should slow down some of the needless spending that people have. I find it extremely funny that the correlation between really cheap debt, social media, and our materialistic society all kind of converge in the past decade and a half or so, where we have this, since social media came out and really started taking over people's lives, cell phones started taking over people's lives, has been probably the past 10 years, right? Instagram, Facebook, all this kind of stuff. And now we also have super cheap debt. We had super cheap debt, right? And people could buy their ridiculous homes and post pictures of it on social media and have the dick measuring contest and popularity contest that they thought they left behind in high school, now only on social media. So, It all kinds of, I think it all kind of wraps into each other in the aspect of everything is about appearances. Everything is about how much you can purchase, regardless of how much it's going to cost you. And now that we are starting to see the economy slow down because of the interest rate hikes, I'm hoping that we can finally understand as a society, which this is probably wishful thinking, that materialism and the idea of being able to buy whatever the hell we want in order to impress people online that we never talk to, maybe that will slowly go away. Now, like I said, that's probably wishful thinking because a lot of people still believe that, if they can, even if they pay 7% for a house or whatever, it's still worth it because you'll get the equity in the home and it'll continue to go up over time. I hope that's not true because houses as it is right now are ridiculous. They've gone down over the past probably 3 to 4 months because of, an increase of supply and a decrease of demand. But I am not a homeowner. I rent, and I would like to buy a home at some point, I'm sure, but it is becoming more and more likely for me that I may just save up money and build a cabin in the middle of nowhere, buy some land and build a cabin in the middle of nowhere with cash and just call it a day, or buy one of those boxables. I was watching a video today about Elon Musk purchasing a boxable and living in a boxable. The guy has like $200 billion and lives in 400 square foot, place. Like, that doesn't sound too bad if you don't have debt, you don't have a 9% mortgage rate on that, right? So I don't know. That kind of speaks to a lot of different things. But our society, I'm hoping here, and this is a bad hope because a lot of people are going to get damaged in this, but the coming recession of 2023, and increased unemployment, increased interest rates, oversupply of cars, oversupply of houses, I think maybe will start to curb people's social media addiction and jealousy addictions and materialism to the point where we can actually get back to a regular society where things are defined, and people's value is defined by what they do with their lives and what and how happy they are, not how many Instagram likes they get on their new home, or, oh, look, mommy, I just bought this, or my dad just bought me this new King Ranch, Ford F-350, or, I just bought this new Lincoln, whatever, Aviator SUV or whatever. Look how cool I am, even though it's a $70,000 car that, you're going to be paying $1,300 a month in car payment, in just the car payment alone, right? Every month. It's asinine. And it's going to absolutely ruin my generation of millennials. And Gen Z, I think, is even more susceptible to that they will be in debt so far up to their eyeballs that they will literally not be able to function. So that's the big point today. I don't want to harp on it too much because I said I was going to make this a short video, but that's materialism for you and my views on materialism. And hopefully this interest rate hike in the FOMC and unfortunately the upcoming unemployment spikes that are going to be happening, the unpredictability of the labor markets and such, I think that will kind of curb some of that. Hopefully we learn our lesson this time compared to 2008, which we obviously didn't. But I think this may be worse than 2008, the upcoming recession / global depression, because I think a lot of big companies, are going to go out of business all over the place. So you're already seeing a lot of big companies now going out of big corporations going out of business now. So anyway. That's all I have to talk about for today. Please go follow my social media accounts, David Coleman YT on Instagram. I'm posting reels on there every day now to keep people updated. On Twitter, it's Colema, Colema 63 ETH. On Rumble, it's David Coleman 27. Been posting to there every time I post to YouTube also. And then on YouTube, it's just David Coleman. So I think my tag on YouTube is at OME Hacks. OMEHAX, and I think that's because I created my YouTube account probably when I was in like sophomore, junior year of high school or something like that, and apparently this was the tag they gave me. I must have selected it honestly, and here we are. So that's all my social medias. Go follow them. Please like and subscribe. Check the notification bell. We're going to continue to do this. This is my 3 for 3 this week on videos. I'm going to try to do this every day, like I said. And we'll keep going as long as you guys keep watching and subscribing. So thanks so much, and we'll see you on the next one.